Hello traders, welcome back to another episode of the free Smart Money Concepts course. In this video, we are going to learn about two important reference areas or zones in SMC. I will talk about breaker blocks, mitigation blocks, and how you can use these concepts to improve your chart analysis. I will explain what these are, the psychology behind them, and why they work in the market. We will also learn how to identify and trade them. So traders, if these series of videos are useful to you, please hit the like button to show your support and subscribe if you're new to this channel. So without wasting any time, let's get started. Breaker blocks and mitigation blocks are reference areas on charts where you can potentially find a trade opportunity. Breaker block and mitigation block concepts are almost the same, but their formation pattern is different. The general definition of a breaker block and mitigation block are similar. The general definition states that a breaker block or even a mitigation block is a failed order block that turns into another supply or demand area on the chart. From my basic price action course, we know that whenever the price breaks through a resistance level, it becomes a support due to the behavior of market participants. Similarly, whenever the price breaks through a support level, it starts to behave like a resistance when the market taps into that area again. This is the simple principle of polarity. The same concept applies to breaker and mitigation blocks as well. The market could ignore an order block's supply and demand for many reasons. These could include a shift in the market structure, price being overvalued or undervalued, price tapping into higher time frame key levels or prices of interest, and there can be many more such reasons. Now, when a valid demand level fails to reject the price, and if the price breaks through, it becomes a supply level. The overall logic is correct, but involving order blocks into the mix is what I cannot digest. Considering mitigation blocks and breaker blocks as failed order blocks doesn't always make sense. If you have watched my video on order flow and order blocks, you might have noticed the number of criteria that needs to be satisfied in order to identify a valid order block, be it a valid market structure break, an inducement, a proper liquidity sweep, presence of an unmitigated imbalance, etc. You might have also realized that order blocks are not always found at the extreme swing points. We might have to shift our order blocks for obvious reasons. Now look at these two figures where I have marked a breaker block and a mitigation block. One thing that catches the eye is that both these figures are associated with a change in the market structure or simply a change of character. Another important observation is that both these blocks are formed at the extreme points of the price swing. So calling it a failed order block doesn't actually do justice for order blocks because order blocks don't always get formed at the extreme swing points. This is why I don't want to involve order blocks when it comes to breaker blocks and mitigation blocks. There is one other obvious reason which will strengthen my analysis. Comment down below if you have spotted it. I will reveal it when we talk about the mitigation blocks. Having said that, what is a proper way to define breaker blocks and mitigation blocks? This idea is simple to grasp if you associate it with basic price action. In the smart money trading concept, it is called a breaker block and a mitigation block. And in the price action concept, it is called a breakout and retest. The idea behind a breakout and retest, or breaker block or mitigation block, is that if the market can successfully retest the breakout level and continue in the same direction of the breakout, it confirms the breakout's validity and suggests that the market will likely continue moving in the direction of the breakout. In SMC terms, there is liquidity on offer above the extreme swing highs and below the swing low levels. So here in search of liquidity, the market can break through the extreme swing low level, forming a bearish change in the market structure. This further brings in a lot of sellers who would start shorting the market while placing the stop losses above the extreme swing low level or the support. So the market will likely return back to sweep these stop losses and limit orders which are accumulated above the support. So this is actually the reason why breaker blocks and mitigation blocks work in the market. Let's learn how to identify a breaker block. A breaker block involves looking for key support or resistance levels on a price chart that may cause a significant change in the price direction when the level is broken. So when a support resistance or supply demand level is breached, it is considered as a significant signal that the price may continue to move in the breakout direction. Once the breakout is established, we have to wait for the price to return to the breakout level to confirm that it has become a new support or resistance level. And once the level has been confirmed, traders can enter a trade in the direction of the breakout. So a breaker block can be an area of supply or demand which was broken through by prices, leading to a change in the structure, and it is only confirmed after price retest back to the breaker block. It should be noted that the polarity of the breaker block changes after the breakout. That is, if it was a supply zone, it would become a demand zone after breakout and vice versa. This is the whole idea behind identifying and trading breaker blocks. But let's dive deeper into the entire process. We will begin our discussion with a bearish breaker block. For identifying a bearish breaker block, first we need to identify a swing high and a swing low in prices. Then, the market should break above the high to form a new higher high. We don't have strict rules here, like the price should break and close above the previous high and it should take out an inducement. Nothing like that is required here. Even if all these conditions are met, then also it is fine. In this case, the price has to just break above the previous high to create a higher high point. This could even be the wick of a candle. It should just sweep the liquidity available above the previous high. But if this move is associated with an inefficiency, then it would be even better. This would mean that more participants would expect the price to come back lower to fill the imbalance, and these players will look to go long from these discounted valuations. Once the higher high is formed, the price should move lower and break below the previous low to create a lower low. But here, it is recommended that we should wait for the price to actually break and close below the previous low. So essentially, there is a break of a high and a low. Once the lower low is confirmed, we can identify a breaker block. For this scenario, the last down close candle or the deepest or lowest candle in the group of the last consecutive down close candle will be our bearish breaker block. In case if there are 3 or 4 consecutive down close candles, you have two options. One is to mark the whole area from the highest to lowest point, including the wicks. The second option is to mark only the highs and lows of the last down close candle or the lowest candle in the mix. I would recommend using the second method because in the first scenario, the risk associated with it and the stop loss placement would be higher. It is vital to involve the lowest candle in the swing low, and it doesn't matter what the color of the candle is. Now, this block used to be a demand zone, but now it has been converted to a supply zone. Unlike the case of an order block, we don't have to see if there is an imbalance and a liquidity sweep, and unlike an order flow, we don't need to check if it is unmitigated. For a bearish breaker block, we just need to find the last down close candle or the lowest candle in the series of consecutive down candles and mark them from wick to wick. Once the breaker block is identified and marked, we expect the price to return back to this breaker block and then continue to decline lower. The breaker block is validated when the price returns to retest it. But here, I would like to add an additional condition to make this setup a high probability one. The condition is simple. When the price breaks through the breaker block, it should be associated with an imbalance or a fair value gap. Specifically, a CB, that is a sell side imbalance and a buy side inefficiency. If a sell side imbalance is generated during the breakout below the breaker block, this will become a high probability setup because it gives price more reason to retest our breaker block as the price imbalance need to be filled in order to make the market efficient again. This setup is known as the unicorn setup. Let us briefly understand the logic behind the whole concept. The market forms a new higher high, but contrary to forming a higher low, the market breaks below the previous low and makes a change of character instead. As a result of the aggressive move breaking below the previous low, the directional bias has changed to bearish and our demand level will turn into a supply level after this break has occurred. The psychology behind the breaker blocks is that the traders who got long from the demand areas are now trapped after the bearish market structure shift. So they would want to wait for the price to get back to their break-even spot where they can close their long positions for little to no losses. Also, traders will start taking short trades here since they see this area as a key area of supply. The outcome of this double action is what makes the price reverse from this area. So one of the key points here is that a breaker blocks forms when we have a run of liquidity before a market structure shift. Keep in mind that this breaker block concept is applicable to the internal market structures also. We can take trades from breaker blocks when they are formed within the minor structure. Breaker blocks are one of the 7 institutional reference points in SMC, which is very important when using the PD arrays. We will talk about PD arrays in the penultimate episode of this season. Anyways, when price returns back to the bearish breaker blocks and move lower, we can look to enter into short trades. Now, another thing you can do is to draw a Fibonacci retracement connecting the highest and lowest points on the breaker block. We only need the 0%, 50%, and 100% Fibonacci levels. You can adjust this in the settings. This way, we can optimize your trade entries. You can look to place sell limit orders or take short trades between the Fib 0.5 and Fib 0 levels. You can set your stop loss above the breaker block or above the Fib 1 level. You can set your targets based on the previous market swings, or you can even use the price projection method for setting the take profits. We will talk about breaker block trading strategies in the second season of the SMC course. Anyways, let's now learn about bullish breaker blocks. Here also, we need to identify a swing high and a swing low. The price should take out this low and form a new lower low. This is a liquidity sweep below the previous low. It is better if this particular move is associated with an inefficiency. Once the lower low is established, we want the price to swiftly move higher and break and close above the previous high, thereby forming a new higher high. When the price breaks out above the previous high, we can mark the last up close candle or the highest up close candle or the group of consecutive up close candles in the swing high. This becomes our bullish breaker block, which acted as a supply zone before, but now it is converted to a demand zone after the structure change. As mentioned before, it is ideal to mark only the last up close candle or the highest up close candle when dealing with a group of candles when drawing the breaker block. The color of the candle doesn't really matter. This will help us with better risk management. Now, if the breakout move is associated with a fair value gap or an imbalance, specifically a BC, that is a buy side imbalance and a sell side inefficiency, this gives price a reason to return back to fill the imbalance and thereby test our breaker block. Then this becomes a high probability trade setup known as a unicorn setup. Now, when the price returns back to our bullish breaker block, we can plan to take long trade positions. You can use a Fibonacci retracement tool to mark the Fib 0, Fib 0.5 and Fib 1 levels by connecting the lowest and highest points in the bullish breaker block. This will help you optimize your trade entries. You can place buy limit orders between Fib 0 and Fib 0.5 levels. You can set your stop loss below the breaker block or below the Fib 1 level. You can set your targets based on the previous market swings, or you can even use the price projection technique for setting take profits. So some of the key factors that you need to consider while trading breaker blocks are: number one, market structure. You need to identify the current market structure before looking for breaker blocks. Market structure includes defining the market direction, supply and demand areas, higher time frame key levels, liquidity areas, etc. Number two is validity. Make sure the breaker block you identified is valid. Breaker blocks are created by a run of liquidity before the market structure shift. So you need to look for sharp moves with fair value gaps between the wicks that creates inefficiency. And finally, number three is confirmation. Wait for confirmation before entering a trade. Confirmation can be in form of many price action signals, candlestick signals, volumes, etc. Now, let's quickly dive into mitigation blocks. We will begin with a bullish mitigation block. So first, we need to look for a swing high and a swing low. Then mark these points. Now the prices moves down, but it fails to break below the low. It is unable to take out the liquidity below the low. The price moves higher swiftly, breaking through the high and closing above the high, resulting in a market structure shift. Once the breakout above the high is established, we can mark the last up close candle or the highest candle in the series of up close candles forming the previous swing high. This will be our bullish mitigation block. It is ideal to mark the highs and lows of the last up close candle or the highest candle in the mix as the bullish mitigation block when there are multiple consecutive candles, as it provides better reward to risk for the trades. Now the color of the candle doesn't really matter much. In addition to this, if the breakout move is associated with an imbalance or a fair value gap, more specifically a BC, that is a buy side imbalance and a sell side inefficiency, then this will become a high probability setup for our trades. This inefficiency will be a motive for prices to return back to fill the imbalance and thereby even testing our bullish mitigation block. We can look for long trades from this mitigation block. You can also optimize your entries using Fibonacci levels. For this, extend a Fibonacci retracement from the lowest to highest points of the mitigation block. We only require the 0%, 50% and 100% levels. So the idea is to place buy limit orders between fib 0 and fib 0.5 levels. You can set your stop loss below the mitigation block or below the fib 1 level. As you can see, the only difference between a bullish breaker block and a bullish mitigation block is that the breaker block is associated with a liquidity sweep below the lows, thereby forming a lower low. But in case of mitigation blocks, price fails to execute a liquidity run below the previous low, thereby failing to create a lower low. This is the reason why mitigation blocks are also known as swing failure patterns or swing failure blocks. This also proves another important point. Since the price was unable to break the previous low, this means the use of order blocks as mitigation blocks cannot be justified. Think about it. The first condition that needs to be satisfied if we are to identify order blocks is that the market needs to form a valid breakup structure. But here, the price didn't even sweep the previous low. So the concept of order blocks being used as supply or demand area is significant in this case. This is why I refuse to accept the idea of mitigation blocks and breaker blocks being considered as failed order blocks. I hope you get the essence of it. Now keep in mind that just like a breaker block, the mitigation block is also one of the 7 institutional reference points in SMC. Mitigation block trading is also applicable in minor structure. Mitigation blocks can be used to take trade positions from the internal market structure when formed within a PD array. Now let's quickly touch upon a bearish mitigation block. As always, identify the swing high and swing low in prices. In this case, price fails to sweep the liquidity above the high and it swiftly declines down, breaking and closing below the previous low. So the price was unable to establish a new higher high. So this is a swing failure. Once the breakdown below the low is confirmed, we can mark the last down close candle or the lowest or deepest candle in the mix, including the wicks. And this will be our bearish mitigation block. If there is a price imbalance or a CB associated with the breakdown move, then the probability of price returning back to our mitigation block increases because the price will try to fill the inefficiency. For trade entries, use fib 0 and fib 0.5 levels to place sell limit orders. You can set the stop loss above the mitigation block or even above the fib 1 level. Now being a swing failure pattern, I'm not particularly interested in trading from these mitigation blocks because liquidity is still available beneath these swings, due to which the market could just reverse, thereby hitting our stop losses and taking us out of the trade. So be a little cautious while dealing with mitigation blocks. Now that is all for this video. If you have come this far, thank you for watching this video. I hope you have found this video informative. If it was useful, please make sure to like and share this video with your friends and fellow traders. Also, don't forget to hit the subscribe button and turn on the notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. I appreciate your support and I look forward to seeing you in the next episode. Till then, bye.